Just in terms of, again, evaluating risk, etc., across the portfolios that you guys own, I think I'd be right in saying that the vacancy rates are generally down and your renewal rates are probably at a different type of level pre the cyclical low, if you like. Do you think that the renewal rates in particular and how you manage the portfolios, do you think that those risks are being priced in effectively? Because I know in the US, for example, and there'll be some US investors in the audience who are new to the European market, they price things differently, both in terms of renewal rates and also lease lengths.
Good. Does anyone want to take that?
And I think that there's a couple of things. One in this sector, I think, and this is a point that Rob was, I'm not going to take credit for Rob's point, but the figures you saw earlier were, I believe, for industrial and logistics, not just for logistics. And I think that the industrial, there is higher risk in industrial, especially if some of those portfolios will be some of the smaller industrial units, than there is in big logistics. And one of the things with big logistics, it's not, we don't see at the end of a lease that someone says, as in offices, well, I can pack my computer, pack my furniture, and I'll move to a new facility. Moving, 500,000 square feet, 50,000 square meters of warehouse space is not something you do lightly. You also have various staff issues, etc. So I think we're seeing in this market, and partly it's driven by the fact that there is no new product being built, but we've seen our occupancy in Germany, we're up in the 96%. The bits we have empty are some offices we'll never let. And across our portfolio, we've seen it getting higher and higher. And the rollover or the seeing tenants stay, again, has got higher and higher. And most tenants will only move if there's a real business need for them to move, not just because a rent somewhere else is a little bit cheaper.
Good. Rob?
Yeah, I was just going to come back to some of the commentary about the return makeup, and we've talked about the sort of the income component, the capital growth, and I think we're a little bit more optimistic about the capital side, which we see as being, it might actually be a combination of some continued inward yield shift, but also most forecasters are expecting an element of rental growth, which is probably a new phenomenon for the logistics sector for a little while, except again in various hotspots, as James highlighted. There are certain markets where they have seen rental growth over the years, but I think we expect that to come through. And when we look at the various sectors, so not just logistics, and we look at the amount of supply that's being created, and I think this has already been touched on, but the proportion of total stock that's under development or in the short term is at its lowest levels for some time, but yet take-up is also at its highest levels since I think most records began on the pan-European basis. So I think that we do expect that can provide for some rental growth going forward. May not be as much as in the office space, where the supply-demand dynamic might be slightly stronger, but nonetheless some rental growth. So when you're starting from a yield comfortably into the sevens, and you've got a little bit of growth on top, I think it comes back to that point that it's attractive. Then one last comment, if I can, coming back to your comment about bond investing and the income return. We shouldn't forget the fact that these assets will also generate some inflation hedging as well, which is extremely attractive to investors long term. And the types of entrant we've seen, larger pension plans, sovereign investors, that kind of hedging against inflation over the long term is also very attractive. So that's driving it as well.